If you want to clear a room at a dinner party, I have a foolproof strategy for you. Just, wait for a lull in the conversation, lean in, and start talking about derivatives.
That is the nuclear option.
That works every time. It's got this dual reputation, doesn't it? On one hand, people think it's boring calculus homework.
Right.
And on the other, they think it's this financial weapon of mass destruction that blows up economies. So it's either incredibly dull or incredibly dangerous.
It's the boogeyman of finance. Yeah. Most people assume it's just guys in expensive suits screaming at computer screens about alpha and beta, dealing in things that aren't even real.
But here's the thing, and this is why we are doing this deep dive into the NISM Chapter 1 source material today, that reputation is, well, it's totally unearned, or at least it's widely misunderstood. We aren't looking at Wall Street jargon. We're looking at a tool humanity invented to handle the one thing we are all terrified of.
The unknown.
Exactly.
And that is the mission today. We need to strip away the math and just look at the mechanics. Because at its core, the source material isn't describing a casino. It's describing a risk management system that has been running for, nearly 1,000 years?
So let's just cut through the noise. We need a definition, but let's keep it practical. It's right there in the name, isn't it?
It is a derivative. It has no value of its own. It derives its value from something else.
The underlying.
We call that something else the underlying.
I think of it like a shadow. If the object moves, the shadow moves. If the object disappears, the shadow's gone. You can't trade the shadow without referencing the object.
That is a perfect way to put it. And the NISM workbook lists a surprisingly broad range of these objects or underlying assets. It's really not just stocks.
Right. I was looking at that list. It feels very, very tangible. You've got metals like gold, silver, aluminum. You've got energy, oil, coal, even electricity.
And agricultural commodities. I mean, wheat, sugar, coffee, cotton.
So whether it's a physical bushel of wheat or an intangible interest rate or a share of some tech company, if you build a contract based on its changing value, you've built a derivative.
Exactly. You are trading the risk associated with that asset without necessarily having to, haul the asset around in your truck.
Okay, let's unpack this.
Yeah.
Because usually when people explain this history, they start with like the Chicago Mercantile Exchange in the 1970s. But the research here goes back way, way further.
Oh, yeah.
We're talking medieval Europe.
The 12th century, to be exact. The source traces it to European trade fairs. Sellers would sign contracts promising to deliver goods in the future, but the real light bulb moment for me, and the part that usually surprises people, is the 13th century.
The English Cistercian monasteries.
Yes.
This is my favorite detail. These weren't high-frequency traders in Manhattan. They were monks raising sheep in the English countryside.
Who were apparently very financially savvy. They needed capital to expand their operations, build barns, that sort of thing. So they sold their wool to foreign merchants in advance.
But we aren't talking about next season's wool.
No. They were selling wool for up to 20 years in the future.
20 years. They were selling the fleece off the backs of sheep that hadn't even been born yet.
It sounds wild, but just think about the utility there. The monks got the cash up front, which they needed right then. The merchants locked in a price and a guaranteed supply for 2 whole decades.
So it was a forward contract in everything but name.
Pretty much. It solved a problem for both sides.
But then history shows us the other side of the coin, right? The dangerous side. We have to talk about the tulips.
You can't talk derivatives without the Dutch tulip mania of the 1630s. It's the classic cautionary tale. People started trading contracts for future delivery of tulip bulbs.
Okay.
But at some point, it stopped being about the flower and became entirely about the price.
Pure speculation. People buying contracts just to flip them to the next guy for a profit.
Precisely. Prices went to the moon, a massive bubble formed, and when it popped, fortunes were wiped out overnight. It proved that while these are useful tools for monks and merchants, they can weaponize human greed if they aren't regulated.
So you have the monks using it for funding and the Dutch using it for gambling. Then you get the Japanese, who I think really professionalized it in a way that looks like the modern market.
The Dojima rice market in Osaka, late 1600s, this is so crucial. This wasn't just gambling. Rice was basically the currency of the day. Samurai were effectively paid in rice.
So if the weather was bad or the harvest failed, your salary basically just dropped.
Right. So the farmers and the merchants developed a pretty sophisticated futures market to hedge that exact risk. They were protecting themselves against bad harvests, weather events, warfare, you name it.
It was actual risk management,
Yeah.
standardized and regulated, 3 centuries ago.
And that leads us directly to the modern era. The American evolution really feels like the industrialization of what the Japanese were doing.
1848, that's the key date there.
Right, the Chicago Board of Trade, or CBOT, opens. And initially, they just facilitated these private forward deals we talked about. But in 1865, they did something truly revolutionary. They listed the first exchange-traded derivative. They called it a futures contract.
Which brings us to the evolution of the assets themselves. It started with butter and eggs, didn't it?
Literally. The Chicago Butter and Egg Board, that eventually became the CME, the Chicago Mercantile Exchange. But the 20th century is where it just explodes. 1972, you get currency futures. 1973, options. 82, stock index futures. We went from protecting egg prices to protecting entire portfolios.
Okay, I want to pause on something you just mentioned. You distinguish between a forward deal and a futures contract. To the average person listening, those sound, well, they sound like synonyms.
They do.
But the source material makes a huge deal about the difference. It seems like the hinge the whole market swings on.
It is the difference between a handshake and a law.
Okay, let's break that down. Start with the forward.
A forward contract is bilateral. It's just you and me. Let's say you agree to buy 100 bags of rice from me in 3 months at 40 rupees a bag. That's a private, over-the-counter, or OTC deal. It's completely customized to exactly what we want.
Which sounds great, right? I get exactly the rice I want when I want it. Customization is usually a premium feature.
It is, until the market moves against you. Say the price of rice in the open market drops to 30 rupees. You're now locked into paying me 40. You're losing money on every single bag.
So I might be tempted to just stop answering your calls.
New phone, who dis? Exactly. That is counterparty risk. I have to trust that you're going to honor the deal even when it hurts you. If you do fall, I'm left holding the bag literally. Plus, it's a liquid. I can't just sell our weirdly specific deal to someone else.
So futures were invented to fix a flaking out problem.
Yes. A futures contract is an exchange traded forward. The exchange steps right in the middle. They standardize everything, the quantity, the quality, the date. The only thing we negotiate is the price.
And the trust issue. How do I know you won't bail?
That's solved by the clearing corporation. They act as the buyer to every seller and the seller to every buyer. They guarantee the trade. So you don't need to know if I'm good for the money. You just need to know the exchange is good for it.
So forwards are custom but risky. Futures are rigid but safe.
That's the trade-off. What's fascinating here is that the exchange removes the personal relationship from the equation entirely, just to ensure stability.
So what does this all mean for India? How did this monster land on Indian shores? Because for a long time, Indian markets were strictly cash-based.
It was a very careful, deliberate process. The government did not want a repeat of tulip mania. So in 1996, SEBI set up the LC Gupta Committee. Their mandate was essentially figure out how to do this without blowing up the economy.
And the biggest hurdle was a legal one, right? I remember the notes mentioning something about definitions.
It was existential. They had to legally declare derivatives as securities. Now, this sounds boring, but it was absolutely vital. It brought them under the regulatory umbrella of the SCRA. And once that legal framework was set, they had to figure out the safety mechanics. That's where the J.R. Varma Committee came in, back in 1998.
Right, the Varma Committee. They were the ones who built the safety rails, the margins, the net worth criteria, basically ensuring that if people lost money, the system itself didn't collapse.
Exactly. And once those rails were down, the floodgates opened pretty fast.
It was a rapid rollout.
Very. June 2000, you have Index Futures Nifty and Sensex. By 2001, we had options and stock futures. In just about 25 years, India went from zero to having the largest volume of derivatives contracts in the world.
That is just staggering speed. Now let's look at the people inside this massive machine. The source material outlines 3 distinct participants. It kind of reads like a movie cast. You've got the hedgers, the speculators, and the arbitragers.
And they all need each other. That's the key insight here. You can't have a market with just one of those types.
Okay, let's start with the hedger, the responsible one.
The hedger is risk-averse. So think of that monk or the rice farmer. They already own the asset, the crop, the stock portfolio, and they are terrified the price is going to drop. They use derivatives as insurance.
They aren't trying to make money on the trade itself.
No, not at all. They are paying to sleep better at night.
Then you have the speculator, the Wolf of Wall Street type.
The risk takers. They don't want the rice. They don't want the oil. They just have a view, a prediction on where the price is going.
Now, usually speculators get a bad rap. They're seen as just gamblers destabilizing the market. But the notes here imply they're actually necessary.
They're crucial. Think about it. If everyone was a hedger, Everyone would be trying to sell risk. Who buys it?
Ah, I see.
The speculator steps in and says, I'll take that bet. They provide the liquidity. Without the speculator, the farmer can't hedge because there's just no one on the other side of the trade.
That's a great point. They are the other side of that safety trade. And then we have the third character, the mysterious arbitrager.
The risk-free profit hunter.
Which, that just sounds like a scam. Risk-free usually comes with a huge asterisk.
In this case, it's really just math. An arbitrager looks for a glitch in the matrix. Let's say a stock is trading at 100 rupees in the cash market, but the futures price implies it should be 105. If the interest rate math says it should only be 102, there's a gap.
So the prices are out of whack.
Exactly. So the arbitrager buys the cheap one and sells the expensive one simultaneously.
Instantly locking in that difference.
Instantly. And by doing that, by buying the low and selling the high, their own activity forces the prices back together.
So they are effectively the market's autocorrect function.
That's a brilliant analogy, yes. They profit from inefficiency, and by doing so, they make the market efficient for everyone else.
We've talked a lot about futures, but we should briefly touch on the other big instruments in the source, options and swaps.
Options are distinct because of one key word, choice.
Right. Futures are an obligation. You must buy or sell no matter what.
Correct. An option gives you the right, but not the obligation. If I buy a call option on a stock, I have the right to buy it at a set price. If the stock crashes, I can just walk away. I don't have to buy it.
But you paid for that privilege.
You paid the premium. That's your maximum loss. It's exactly like car insurance. You pay the premium, and if you don't crash your car, you don't get your money back. But you were protected.
And the person selling that option, the insurer.
The writer. They collect the premium, but they are on the hook. If you decide to exercise your right, they must fulfill it. So they have limited profit. Just the premium, but potentially unlimited risk.
And swaps. The notes treat them pretty briefly.
Think of swaps as just a series of forward contracts all stitched together. They are mostly used by big banks and corporations to exchange cash flows, like swapping a variable interest rate for a fixed one. It's huge institution-level stuff, less relevant for an individual trader, but vital for the economy.
And we should just reiterate that distinction between the OTC market and the exchange-traded market one last time.
Right. OTC over-the-counter is decentralized, negotiated over the phone, carries that counterparty risk. Exchange-traded is standardized, anonymous, and guaranteed by the clearing corporation.
So we have this massive, complex machinery. Hedgers, speculators, monks, algorithms. Why do we need it? Why can't we just buy and sell stocks like normal people?
Well, if we connect this to the bigger picture, it really does three main things. First, price discovery. The futures market often reacts faster than the spot market. It gives us a window into tomorrow's prices, today.
Okay.
Second, risk transfer. It allows us to move risk from people who can't handle it, like our farmer,
Right.
to people who actually want it,
Okay.
like the speculator. And third, it brings speculation into the light. People will always bet on the future. Would you rather they do it in a regulated, transparent exchange with margin requirements, or in a dark alley with no rules?
Definitely the exchange. And here's where it gets really interesting. The source material has a massive warning label. It's not all sunshine and hedging.
It does. This is not free money. Not at all.
It lists a bunch of risks. Price risk, liquidity risk, operational risks.
But the biggest one is leverage. In the cash market, if you have 100 rupees, you can buy 100 rupees of stock. In derivatives, because you only have to pay a small margin, that 100 rupees might control 500 rupees of stock.
Which is great if the stock goes up. You've just multiplied your gains.
And it is catastrophic if it goes down. You can lose much more than your initial capital. The workbook explicitly mentions the model risk disclosure document. Brokers must show this to you. It's basically the Surgeon General's warning for finance.
It's a stark reminder that while the clearinghouse removes the risk of the other guy failing, it doesn't remove the risk of you being wrong.
Spot on. The system works, but it's absolutely ruthless.
We've covered a lot of ground today,
Oh.
from Cistercian wool to modern nifty futures. It's just fascinating how we've built this whole mathematical fortress just to deal with the simple fact that we don't know what tomorrow holds.
It is. But I want to leave you with one final concept from the text that I found really provocative. It's called convenience yield.
That sounded really technical when I read it. What does it actually imply?
It's the idea that sometimes people will hold a physical asset like oil or wheat, even when all the math says they should sell it and just buy a future because it's cheaper. They keep the physical goods simply for the comfort of having the inventory physically on hand. just in case of a crisis.
The prepper mentality. I can't eat a futures contract.
Exactly. It suggests that even in a market that's dominated by algorithms and supercomputers and ruthless calculus, human psychology still dictates the price. We will actually pay a premium just to feel safe.
So underneath all the calculus, it's still just human nature.
Always.
That is a perfect place to stop. Thanks for helping us decode the beast.
My pleasure.
And to everyone listening, remember, the market is just people trying to predict the future. Good luck with yours. We'll catch you in the next deep dive.